When beginners first encounter technical analysis, it often feels like stepping into a foreign world, lines zigzagging across a screen, mysterious shapes forming patterns, indicators swirling in colors, and traders speaking in terms that sound almost mystical. But beneath the surface of charts and signals lies something far more intuitive: the study of human behavior expressed through price. Technical analysis is not about predicting the future with certainty. It is about understanding how markets move, how emotions rise and fall, and how crowd psychology leaves footprints on every chart. Once you learn to read those footprints, charts stop looking chaotic and begin to reveal a quiet story, one of fear, optimism, hesitation, momentum, and the timeless rhythm of buyers and sellers. At its core, technical analysis is built on one simple belief: price reflects everything. Every hope, fear, prediction, disappointment, rumor, and expectation is baked into the price you see on the chart. So instead of analyzing financial statements or business fundamentals, technical traders focus on patterns within price movements themselves. They treat the chart as a living map of market behavior, one that can offer clues about where momentum is heading, when trends might reverse, or when a period of uncertainty might give way to a clearer direction. The first step in reading charts like a pro is understanding the basic building block of all technical analysis: the candlestick. Each candlestick shows four essential pieces of information: the opening price, closing price, highest price, and lowest price within a specific time period. A green candle tells you buyers were in control. A red candle tells you sellers dominated. But it's the shape that matters most. A long wick at the top suggests buyers pushed the price upward but were rejected. A long wick at the bottom shows sellers tried to drive the price down but failed. Each candle is like a small chapter in the market's emotional narrative, and when grouped together, they form patterns that traders rely on to make decisions. But candles alone cannot tell the whole story. To read charts like a seasoned trader, you must understand trends, the long-term direction in which the market is moving. An uptrend forms when price makes higher highs and higher lows. A downtrend forms when price makes lower highs and lower lows. And a sideways trend appears when price moves within a tight range, neither rising nor falling meaningfully. Recognizing trends is crucial because trading in the direction of the trend is often far safer than fighting against it. Markets move in waves, and understanding whether the tide is rising or falling gives you a level of clarity that cuts through much of the noise. Once you can identify trends, the next step is learning about support and resistance, two of the most important concepts in technical analysis. Support is a price level where buyers repeatedly step in, preventing the market from falling further. Resistance is where sellers emerge, preventing the price from rising. These levels form psychological barriers. When price approaches support, buyers often gain confidence. When it nears resistance, sellers often tighten their grip. Learning to spot these zones allows you to anticipate potential turning points in the market, much like knowing where a ball might bounce when it hits the ground or a wall. From there, you begin exploring chart patterns, the shapes price creates over time. Some patterns suggest continuation, meaning the trend is likely to continue, while others suggest reversal. Triangles, flags, wedges, double tops, double bottoms, head and shoulders, formations each tells a different story about the battle between buyers and sellers. A triangle often signals compression. The market is gathering energy for a breakout. A double top suggests buyers have lost strength. A head and shoulders pattern hints that a major reversal may be forming. These patterns are not predictions. They are probabilities, visual signals that the balance of power may soon shift. But patterns alone are not enough. To deepen your analysis, you must learn about indicators, the tools traders use to measure momentum, volatility, and possible trend changes. The moving average smooths out price movement, allowing you to see the underlying trend. Short-term averages crossing above long-term ones may signal a shift in momentum. The Relative Strength Index, RSI, measures whether an asset is overbought or oversold, revealing whether price has stretched too far in one direction. The MACD indicator compares two moving averages to show momentum shifts. These indicators are not commandments, they are clues. They help you interpret what is happening beneath the surface of raw price action. Over time, you begin to see that technical analysis is not merely about charts. It is about patterns of human behavior repeating themselves across decades. People fear the same way they feared 50 years ago. They chase excitement the same way they did during every market bubble. They panic the same way they have during every crash. And because human nature does not change, patterns on charts repeat. This is why technical analysis continues to work, not because charts can predict the future, but because human psychology is astonishingly consistent through generations. Yet, even with all this knowledge, the challenge of technical analysis remains: interpreting signals without becoming emotional. Many beginners learn indicators and patterns, but still struggle because they react impulsively, entering too early, exiting too late, or mistaking normal fluctuations for major trends. The true skill of a technical trader is patience. It is waiting for confirmation rather than guessing. It is allowing the chart to reveal its story rather than forcing an interpretation. Good traders listen more than they speak, observe more than they act. Another key element is understanding volume, the number of shares or contracts being traded. Volume reveals conviction. A price move with high volume suggests strong participation from traders and institutions. A move with low volume may be weak or unreliable. When price breaks through support or resistance with significant volume, the signal becomes stronger. Volume acts as the voice of the market, telling you whether traders believe in the move or are simply drifting along. As you become more comfortable with charts, you begin to recognize that technical analysis is less about prediction and more about probability. No pattern guarantees an outcome. No indicator is perfect. Technical traders do not aim to be right every time. They aim to make high-quality decisions based on repeated behaviors and statistical tendencies. They understand that losses are inevitable, but discipline, risk management, and consistency create long-term success. And as this understanding deepens, you begin to see charts differently. What once looked chaotic now appears rhythmic. What once felt intimidating now feels readable. You notice pullbacks forming within uptrends, resistance turning into support, momentum building before breakouts, exhaustion appearing before reversals. You realize that charts, much like music, have rhythm and structure. And once you learn to recognize that rhythm, you start to move with the market instead of fighting it. Eventually, reading charts becomes a quiet skill, a skill you refine over time through observation, restraint, and experience. You stop searching for shortcuts and start listening to what price is telling you. You understand that technical analysis is not about certainty, but about clarity, and that reading charts like a pro is not about predicting every move, but about expecting patterns, recognizing behavior, and responding thoughtfully. And as you come to embrace this mindset, you begin to realize that mastering technical analysis was never about memorizing patterns or stacking indicators, but about learning to see the market as a language once spoken not in words, but in waves, impulses, pauses, and surges. Because once you learn to listen, the chart begins to feel less like a puzzle and more like a conversation. And continuing from that realization, you begin to understand that technical analysis is ultimately a discipline of awareness. Awareness of patterns, awareness of momentum, awareness of emotion, and most importantly, awareness of yourself as you interpret the movement of price. As you move deeper into the craft, something subtle but powerful begins to shift inside you. You stop trying to force the market into your expectations and instead let the market reveal its intentions. You wait for confirmation rather than jumping at the earliest hint of a move. You notice when price respects a level multiple times and when it slices through a zone without hesitation. You begin to trust the rhythm more than the noise. This shift from forcing outcomes to observing behavior is what separates amateurs from professionals. Professional traders do not trade every signal. They trade the signals that meet their criteria. They understand that technical analysis is not about catching every move, it is about catching the right moves. They also understand that missing a trade is not failure, and taking a trade without confirmation is not boldness, but impatience. When you reach this level of clarity, charts stop feeling like a race and start feeling like a landscape full of opportunities, but also full of traps that only patience can reveal. Another deeply important lesson emerges as you practice. Technical analysis is inseparable from risk management. Even the most beautiful chart pattern can fail. Even the strongest trend can reverse without warning. This is why professional traders never enter a position without knowing exactly where they will exit if the market proves them wrong. A stop loss is not a sign of weakness. It is a sign of discipline. It protects your capital so you can survive long enough for your skills to compound. Because in trading, survival is the precursor to success. Likewise, position sizing becomes part of your maturity. Beginners often risk too much on one trade, driven by excitement or fear of missing out. Professionals spread their risk, ensuring no single mistake can ruin their long-term progress. Technical analysis gives you the map, but risk management gives you the vehicle that keeps you on the road, mile after mile, even when conditions become unpredictable. As your understanding expands, you begin noticing the interplay between different time frames. A chart may look bullish on a 5-minute view, but bearish on the daily chart. Professionals learn to align time frames to understand the macro trend before diving into the micro movements. This alignment acts like zooming in and out of a battlefield. You see the overall direction before focusing on individual encounters. Without this perspective, traders get lost in noise, reacting to every flicker without understanding the broader narrative guiding price. Soon, you also discover that technical analysis rewards emotional detachment. When you become emotionally attached to a trade, you stop reading the chart objectively. You interpret signals not as they are, but as you wish them to be. A trader who reads charts like a pro has learned to separate ego from analysis. They do not take losses personally. They do not chase wins greedily. They see each chart as a new opportunity, free from the baggage of previous outcomes. This emotional neutrality is a superpower, and it is built slowly through discipline, repetition, and humility. And then comes one of the most liberating realizations of all. Technical analysis is not about predicting the market. It is about preparing for it. A pro does not say, the price will go up. They say, if price breaks this level with volume, I will act. If it rejects this zone, I will step back. They operate through scenarios, not certainties. This mindset removes the impossible burden of perfect prediction and replaces it with structured readiness. You are no longer trying to control the market. You are learning how to respond skillfully to whatever it decides to do. As the craft deepens, you start to see technical analysis as a mirror of human behavior. Breakouts happen when optimism overwhelms doubt. Breakdowns occur when fear overtakes confidence. Consolidation reflects hesitation, a collective pause as traders wait for clarity. Volume spikes reveal excitement. Momentum fades reveal exhaustion. Every chart is a portrait of our collective psychology, our hopes, our doubts, our impatience, our euphoria. Learning to read charts is learning to read people. And learning to read people is one of the most valuable financial skills you can ever develop. Eventually, the charts that once overwhelmed you become familiar landscapes. You navigate them with calm, with curiosity, with a sense of partnership rather than combat. You understand that technical analysis is not a rigid rule book, but a flexible framework, a way of interpreting the endless dance between buyers and sellers. And when that understanding matures, you realize that becoming proficient is not about memorizing dozens of indicators, but about cultivating the mindset of a listener, an observer, a student of behavior. So as this journey reaches its closing moment, hold on to this truth. Technical analysis is not about mastering tools, it is about mastering yourself. The chart is simply a reflection of human nature unfolding in real time, and your success depends on how wisely you interpret those reflections. If you approach the market with patience, discipline, and humility, the chart will reveal more than patterns, it will reveal opportunity. If this exploration has brought you clarity, if it has helped you see charts not as chaos, but as conversation, I warmly invite you to share your reflections. Your insights help me understand what resonates most deeply with you. And if you'd like to continue growing together week after week, feel free to subscribe or follow so we can keep unlocking the timeless principles that turn ordinary traders into mindful, skillful market readers.